Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. A warning from Nvidia. The U.S. restricts sales to China even more, hitting the chipmaker with a multi-billion-dollar charge. Chips then take even more heat. ASML orders miss estimates. The CEO warns of tariff uncertainty. And the conditions for talks. China says it will agree to trade discussions, but lays out its list of demands. Will that calm over the past 2 days to start the week? Is it being upended? We're looking at a negative start to your equity futures session. NASDAQ 100 leads the losses, down 1.2%, with news that the U.S. has imposed restrictions on Nvidia's chip exports to China, chips that were specifically designed to get around the restrictions to be sold to China. We are off some of the lows on the news that China is willing to talk to the U.S., but only under certain conditions. Maybe the good news, at least for today, is that yields are down, even though we are having risk off. We're down by, let's call it 4 basis points for the front end, 2.5 for the year 10-year. Your 10-year yield stands at 4.30. Again, you don't have that worrying dynamic of risk off plus higher yields. Meanwhile, gold continues to charge higher. There's a spot price for you, that very last asset, up 2.3%, trading above $3,300. That's your markets for this morning. Let's look at some of the stocks moving in the pre-market. With that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So it's all about the chip stocks today. Take a look at Nvidia. We are down around 5% at the moment. The US banning the sale of the H2O chip in China, and Nvidia coming out and warning of a potential $5.5 billion hit, sending the stock lower, and also peers in the pre-market as well. Then here in Europe, ASML missing significantly on its orders in its latest quarterly report. The stock was on course for its worst decline in around 6 months. ASML coming lower and again hitting rival chip makers here in Europe. A bit more positivity on airlines, though. United Airlines jumping in the pre-market. The company made the unusual step of giving 2 forecasts. One if the US goes into recession, one if it doesn't. But overall, it was seen as a positive message, and also the rival airline stocks gaining as well today. As usual, all of that is available wrapped up in our Before the Bell opening wrap on the Bloomberg terminal now.
Joe, excellent work as always. Bloomberg's Joe Easton. Yeah, that United earnings really fascinating. Maybe this is the new playbook for companies as they try to navigate tariffs. So in just a few moments, we're going to be speaking to Peter Oppenheimer of Goldman Sachs. Later in the hour, Steve Ricchiuto of Mizuho Securities. 2 conversations that you do not want to miss. Let's get back to our top story. As Joe was just pointing out, Nvidia shares plunging in the pre-market session, down at least 5%. The company warned that it could take a $5.5 billion hit from curbs on chips it exports to China. For more, let's bring in Peter Elstrom, Bloomberg executive editor for global technology. Peter, these H2O chips, weren't they specifically designed in terms that they wouldn't violate the export restrictions on the U.S.? Why are they being targeted now?
Yeah, that's right, Danny. This is the 3rd round of restrictions from the U.S. government against Nvidia as it tries to sell its chips into China. The first round came in 2022 and then in 2023 under the Biden administration. And now we're seeing the Trump administration move ahead with these H20 chips. Notably, what happened is the H20 chips were the ones that were used by DeepSeek to come out with its breakthrough model that we saw in January. Now we're seeing the Trump administration move ahead to try to block those chips. As you mentioned, Nvidia is going to take a $5.5 billion write-down now for the first quarter. And on top of that, they're going to lose some sales. There are estimates that it could cost $12 to $14 billion for the company in the future. So it's a pretty big setback for them. They've argued that they should be able to sell some of these chips. Otherwise, Chinese companies are going to be even more motivated to try to develop some alternatives.
How likely will that be, Peter? What sort of symbiotic relationship is there? How reliant is Nvidia on China, and how reliant are China tech on Nvidia?
Well, Chinese companies have been trying to buy these chips. Even before the earlier restrictions, companies like Alibaba and Tencent had stockpiled even more advanced chips, the H100 chips that Nvidia could sell a few years back in the past. But now Chinese companies are beginning to turn to some alternatives that they can buy. Domestically, Huawei has been quite aggressive in terms of developing an alternative called the Ascend chip that they are using for AI models. It's not quite as good as Nvidia chips, but they are now being able to scale up. They're able to make some progress in terms of developing those chips. And again, the concern from Nvidia, and they're trying to convey this to Washington, is that if you press China and don't allow them to buy some of our technologies now, they're going to move even more aggressively to try to develop domestic alternatives to these, and that's going to give them a broader foundation to be able to develop important technologies like AI.
Yeah, you got to wonder if that's going to happen regardless, given the current atmosphere. Peter, thank you so much. Bloomberg's Peter Elstrom. Let's talk about these broader equity markets. Joining us now is Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. Peter, really great to see you this morning. Look, we went from expecting an exemption from semis and electronics on Saturday to kind of backtracking on Sunday, and now banning a large chunk of Nvidia sales to China. Just given what we've had over the past few days, how difficult is it to make investment decisions to be bullish on overall equities in this type of environment?
Well, Daniel, it's a very good question. It's a real roller coaster ride. And the point that you make is a very good one. There's still a high degree of uncertainty about where we land in relation to tariffs and therefore the economy. And from that perspective, I think there's further downside risk to equities in the context of this bear market. This is a bear market that we characterize as event-driven. So it was triggered really by a set of tariff announcements that sort of derailed an economy that was moving ahead relatively well. It's possible, of course, that these tariffs are reversed or pulled back more, and that we'll get a healthier recovery from this downturn. But I think a lot of investment decisions, both at the corporate level and from investors themselves, are just being held at bay at the moment as people wait to see. And that's going to create still further downward momentum.
Because it's interesting to talk about this being a bear market, Peter, when we are only down 12% from the highs. That on its surface, you could say this is just a correction. Is there then a mismatch between sentiment and how poorly equity markets are actually doing?
Yeah, well, sentiment is very poor, and this is true in the corporate sector and amongst investors because the degree of uncertainty is so high. Bear in mind that equities, take the US, was at one point down 20% or so. That's a normal characteristic of a bear market. We've seen a good rally, but we should also recognize that in most bear markets, you do get strong rallies as investors iterate every little marginal piece of news in the fear of missing a trough. But the rally that we've seen, I think, is vulnerable to reversing again, bearing in mind that equities are not that cheap. The US market is still trading at around 20 times earnings. That's around the 80th percentile. We don't think there's a lot of downside in valuation, but I think we do see more downside in earnings estimates. They're already decelerating quite rapidly. Our numbers are below consensus. And I think as those earnings numbers continue to come down, we're vulnerable still to a further correction in the nearer term in this equity cycle.
Speaking of earnings, Peter, we have talked to some people who remain optimistic on the market because of this idea that corporate America is resilient. But there has been a change just in the past 2 days in terms of how trade talks are going, and that is targeting a specific companies. We were just hearing from our reporter on what's happening with Nvidia. Yesterday, we learned that China is telling its airlines to halt taking deliveries of Boeing. If we are in an environment where specific companies are being targeted, Peter, does that change the calculus?
Well, it changes it in the sense, again, that it should push up the risk premium because the ability to make and plan longer-term decisions for corporates and indeed for investors is that much more difficult. And as the risk premium goes up, it puts downward pressure on valuations. Having said that, it is important to also recognise there are some fundamental underlying positive support. So you mentioned that corporate balance sheets are strong. They are. Banks' balance sheets are very strong. And that, I think, will limit the extent and the duration of an economic downturn. And for that reason, we would characterize this bear market, this downdraft, as event-driven rather than what we would describe as structural, the type that we saw, for example, around the financial crisis, where a downturn in growth and asset prices really started to hit the private sector, banks, the real estate sector, and so on. I think the risks of that are very small. But, of course, heightened uncertainty is likely to weigh on investor and corporate decisions for some time still to come, I think.
What is that line? Is there a duration where you continue to get this uncertainty that it turns into event-driven to a structural bear market?
Well, I think in our view, as I said, the structural bear market type risks, those of significant imbalances and over-leverage in the private sector, asset bubbles, the sort of things we have typically seen historically before structural bear markets, are not really present. However, we could easily morph into what we call a cyclical bear market. That's the kind of bear market you get in equities around recessions, as investors really start to price in fully the impact of a recession and the effect of that on corporate profits. And that's where valuations typically would need to fall yet further. Our own view is that a recession is not the most likely outcome. Our US economists look at the probability over the next 12 months of a US recession at around 45%. But of course, it could easily morph into a recession if this uncertainty over trade continues to weigh on investment decisions and it triggers a further contraction in activity. And then we would expect to see, again, a little bit further downside in equities, but also the bear market lasting longer than would have been the case if we're in what we see as an event-driven downturn.
And certainly the sector, just differences between how they've been performing this year speak to that, Peter. You have the only two sectors that have done well are the defensive ones of staples and utilities. Would you expect that to be the thing that stays afloat in this market? Is that a playbook, an instructive playbook for how the rest of this year might go?
Yes, I mean, it's not surprising and consistent with our views that in a period of greater uncertainty, both on the economy and on investment decisions, that more defensive industries tend to hold up better because they're less levered or geared to economic outcomes. And that is playing out. We expect that to continue. I would also say that companies with stronger balance sheets are also more attractive in this environment, again, given the degrees of uncertainty, and also longer-term interest rates have remained relatively high despite expectations of policy easing. But of course, as we get towards a trough in this downdraft, the opportunity will also be, although we're not there yet, I think, to rotate into some of the things that have fallen the most, that may be more levered to a potential recovery. But that, I think, still has some time to play out before we get to that point.
Peter, it is so wonderful to have you on. Peter Oppenheimer of Goldman Sachs, one of the best. Let's get you some other top stories that are trending on the terminal this morning. ASML shares sinking after the Dutch equipment maker, reported first quarter orders that missed estimates. It cited weakness in the chip sector. TSMC and Intel are among its biggest customers. The CEO also said that tariffs have increased uncertainty. Meanwhile, in the UK, inflation dipped for a second straight month, offering some relief to households. The drop was driven by cheaper computer games, falling fuel prices, and unchanged food costs. Consumer prices rose 2.6% in March. That is the weakest print since December. The U.S. has softened its demands for Ukraine to pay back aid. Sources tell Bloomberg that the Trump administration cut its estimates for the assistance given to Kyiv from $300 billion to about $100 billion. That revision brings it closer to Ukraine's own estimate of about $90 billion. Coming up on the show, Bloomberg Scoop, China says that it's open to talks with the U.S., but only under certain conditions. We're going to lay out the details for you next on your Bloomberg Brief.
I do have an additional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country except they are much larger. And China wants what we have, what every country wants, what we have, the American consumer. Or to put it another way, they need our money.
White House Press Secretary Caroline Leavitt at yesterday's briefing. And in a Bloomberg exclusive just out in the past 30 minutes, Sources say that China is willing to talk with the U.S., but only under certain conditions, among them showing more respect. Joining us now is Bloomberg's Brendan Murray, who leads our global trade coverage, and from Hong Kong, Asia economy and government editor Alan Wong. Thank you both so much for joining this morning. Alan, let's start with you. What are the conditions that China is supposedly laying out for talks?
Well, China has always said that it's open to dialogue, but that it has to take place on an equal footing. So we just learned in greater detail what that exactly entails. So China is demanding more respect from the Trump administration in order for the talks to proceed. So what that means is partly that Trump should rein in some of its cabinet members who've made disparaging remarks about China, and because this expression of disrespect is impeding what China considers to be its willingness to talk. And the second thing is that China wants the U.S. to appoint a person to represent Trump in these talks. This is also not terribly surprising, given that we've gotten mixed signals from the Trump administration on many trade issues in the last couple of weeks. And China, understandably, is asking for the Trump administration to just point fingers at one person who could speak with authority and represent Trump's interests. And this can be seen as a small step forward because China has fleshed out a bit of the details of its demand for the talks to proceed. But I think it's worth reminding that China has always and publicly said that it's willing to have a dialogue with the U.S. Given the right conditions.
Well, it's interesting because it does seem like it was a little bit one-sided before this. Yeah, China had that willingness. But Brendan, we keep hearing from the White House, be it the president himself or the press secretary there, saying, China, please reach out to us. Please come talk to us.
Yeah, exactly. It's playing this game of, who's going to pick up the phone first. I think it's interesting, the reporting that we have out of China today, in that what is the definition of respect? Does that mean roll some of the tariffs back? Does that mean, some kind of formal statement? And then the other issue of appointing a point person, this is really crucial for China because they need to know if they're dealing with the Treasury Secretary Scott Bessent. Are they dealing with, who's sort of a moderate when it comes to dealing with China and wants to do a deal, or are they dealing with someone like Howard Lutnick on the more hawkish side? That will really determine how China approaches any sort of negotiation, and will send a signal from the U.S. as to how committed the U.S. is to reaching a deal if they get one of the more hawkish or dovish cabinet members from the Trump administration. So it's an interesting back and forth right now, a bit of jockeying to see who can come to the negotiating table and still maintain the leverage that they're trying to apply on each other from an economic perspective.
Well, Brendan, we also have this story. It would seem that the U.S. is also trying to target China in a not head-on way, but kind of a secondary effect way in terms of its negotiations with other trade partners, trying to pressure them to back away from China in order to reach an agreement with the U.S. What does this new strategy, again, as reported by the Journal, potentially look like?
Yeah, so we've had some reporting from our colleagues in Europe that the Europeans just met with the Trump's trade team earlier this week, and they've come away sort of confused and puzzled at what exactly the Trump administration wants, and so that could set the tone for these other talks. We know that Japan is coming to the table. The South Koreans are also scheduled to advance their talks. So it will be interesting to see how this plays out, and if China and the U.S. eventually sit at the negotiating table, we'll by then have a sense for how much the U.S. is willing to give in terms of tariff relief or other kind of measures that would be acceptable to the other side.
Alan, let me just quickly give you the last word, because we also had economic data from China today that looked very strong. What does it tell us about the place that China is coming from in these negotiations and its threshold for economic pain?
Yeah, honestly, the first quarter just sounded ages ago, and talking about past performance sounds really quaint. But the data tell us that China was on a very strong footing, economically speaking, in the first 3 months of the year, with retail sales and industrial production both much better than expected, and investment was also stable and respectable. what this means is that China's earlier measures to, for example, provide consumption subsidies really worked, and that the confidence picked up a little bit. But then what we'll be watching out for going forward is just how much longer these stimulus measures will last and will have an effect on consumption, and of course, how the trade war will play out.
A lot to watch. Alan, Brendan, thank you both so much for your time this morning. Brendan Murray and Alan Wong, you're watching Bloomberg. Welcome back to your brief. I'm Danny Berger in New York. Let's take a look at what's on the front pages this morning. And a lot of these papers are not leading with tariffs today. This is what the New York Times is leading with, that Columbia University says it will reject any deal from the Trump administration that destroys its independence. Columbia's acting president says talks are ongoing. The White House is seeking to place the university under judicial oversight. And of course, less than 12 hours after Harvard became the first university to refuse to comply with the administration's demand. Next up, the Washington Post has this. A federal judge is requiring the Trump administration to provide details of the attempts to return a wrongly deported man from Maryland. The order will require records and sworn answers from officials. Justice Department lawyers are arguing that the judge lacks the authority to force them to coordinate with the Salvadorian government. More to come. This is Bloomberg Brief. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. A warning from Nvidia. The U.S. restricts sales to China even further, hitting the chip maker with a multi-billion-dollar charge. Chips then take even more heat. ASML orders miss. The CEO warns of tariff uncertainty. And the condition for talks. China says it will agree to trade discussions, but lays out its list of demands. A really excellent scoop from the Bloomberg team coming moments ago. That means we are off the lows, considering China's willing to talk, but still not a great future session. Is the calm upended? You can see those losses being led by the NASDAQ 100, down more than 1%. The Trump administration imposing even more restrictions on Nvidia's chips, those shares down more than 5% in the pre-market. The good news for you is that yields are lower. The worrying dynamic had been risk off, with bonds selling off. Today, that reverses, but it is slowing down. Your 2-year yield down 3 basis points at 381. Your 10-year down, let's call it 1, at 432. And gold continues to surge higher. That's what you're looking at, the last asset, up 2.33%, trading at $3,300 for an all-time new record. Now, as the market volatility persists, Ricchiuto, chief U.S. economist at Mizuho Securities, remains optimistic, to some point writing that from this starting point, it is logical that a fundamentally healthy economy can absorb an artificially induced supply shock and avoid the type of credit-induced recession most market participants have experienced in the past. Pleased to say that Steve joins us now. Steve, great to see you.
Good to see you as well.
I mean, we'll take a little bit of optimism where we can get it. At what point do you start to worry, though, that it looks something more ugly, that it does look like a recession of the past?
But you need to have the preconditions in place. And you've got to remember, recessions are something that happen frequently. The ones that we're all paranoid about are the credit-induced recessions. And those are the ones that have existed since 1990. And we've had 4 of them, if you assume COVID was a credit recession as well. All the other recessions were very, very different in nature. They were shorter, shallower. Several of them we were in and almost out of before we realized we were even in them. So there's big difference in the variety of recession. And people have come to assume that every recession is a credit shock. They're not. The preconditions for a credit shock are not in this economy.
Does it look something then more maybe like a Brexit, where it's slow moving, you half maintain global ties, and things generally are worse?
You know, I think that the point that comes down to at the end of the day for everybody is this is the consumer of last resort. Okay, this is also the largest, most leveraged economy in the world. It certainly needs foreign participation to be involved in it. However, the only thing that influences is the price. It doesn't influence the ability of things like the government to fund itself. So I think people are overreacting to things because they want to read into a story that says, Fed's got to cut rates, Fed's got to bail us out, Fed's got to go back to QE, because, hey, we can all make money in that environment. Well, that's not the way it's going to play out this time. I'm sorry to tell you that. This is a very, very different macro environment. This is not a credit crunch that's unfolding in the economy. Liquidity is still available. Markets are still very accommodative. Corporate deals are getting done. We had a very, very large high-yield deal come the other day. We've got another one coming real soon. We're doing IG-related issuance. They're getting done at very, very good levels. So I think the reality is the economists and the strategists are panicking. The rest of the world is not.
I wonder then, because part of the narrative that formed when yields were heading higher, at least on the long end, when assets were selling off, that, okay, if we head into a recession, we're already coming from high levels of a deficit. In a recession, you end up spending even more, and therefore you're concerned about debt levels. Does that not hold true this time if we're not going to get into sort of a garden variety economic time of weakness?
Well, I mean, again, you have to consider the total demand for leverage as opposed to just the Treasury's demand for borrowing. Okay, when you look at the total demand for credit, all non-financial debt, including the budget deficit in this country relative to GDP, is 225%. We were as high as 250 during COVID. Europe is running at around the same level, believe it or not. Japan is running at 425%, and China is running at 325 and rising. So the reality is, does it look all that bad? Not really. And this is where I think you can look at something and you can identify and say, oh, my God, this stands out like a lightning rod. But when you look at it in a broader context, it's like, OK, it's just another thing we have to ride through, and we'll get through it without a problem.
But surely it looks different on the other end, Steve. If we're riding through something where we're almost decoupling from China. Yeah, we're talking about talks today. We're pushing ourselves away from the Europeans, and we're also asking other countries to push away from China, too. Surely we ride this out, but on the other end of it, something has changed.
Well, it does, but at the end of the day, is that the end of the world? Just because it changes at the end of the world. Think about the post-World War II approach towards the Soviet Union. Right? We totally isolated the world from the entire eastern portion of the world, okay? Russia and all the Eastern European countries, totally isolated away from them. We weren't really engaged with China at that particular time. It was a very different China. The reality is Russia was a bigger component immediately after World War II than people consider it actually was. Russia, at one point in time, the USSR, as it came to be known, really had enough ability to really compete with Western Europe and the United States. China doesn't seem to have that level of muscle. So I think, you know, when you put it in the broader perspective of what's going on, we tend to just think about our universe. And yes, our universe is changing. The reality is the underlying economy has dealt with things like this before. It is a different economy, and actually it's a more robust, more sustainable economy, because this is an economy that's driven on services. This is not an economy that's driven off manufacturing.
Fair enough. The manufacturing numbers have looked poor, but to your point, it is economy based on services. I mean, I got to say, David Solomon, I wrote this down from the Goldman Sachs earnings. He was saying it is important to recognize that a few countries have benefited more from the post-World War II economic and financial order than the U.S. Is there a case then where we get through this, we're still strong, but less strong, that growth and maybe even productivity is lessened with the changes that are put into force?
I think you wind up with a higher rate of inflation and a higher rate of interest rates. Now, there's some people at the Federal Reserve who, honestly, going into this overall environment 2 years ago, were sitting there saying, hey, you know, 2% inflation target is probably too low. We should probably looking at 3, maybe 4. So at the end of the day, if we come out of this with 3% inflation, is that really so bad? If your wages are going up at 4% and your inflation is going up at 3%, purchasing power increases, is that so bad? It's different than we experience, but change isn't always bad.
What do you make then of most recent Fed speak, Waller kind of being the exception, being like, the mission needs to be to make sure inflation expectations are well anchored? That seems to be the conversation, unless you are Chris Waller, who says recession concerns are more frightening.
Well, I think the answer is very, very simple, is that the Fed has a dual mandate. And so far, the labor market's doing well. The inflation is now in jeopardy. Going into the tariffs, the Fed was sitting there saying, I have a deflationary bias, so I can focus on the labor market. So now, is there a subtle shift going on, possibly, from the labor market component back to the inflation component? There's nothing wrong with that. It's an appropriate monetary policy response. But again, it suggests the problem is not necessarily with the Fed. The problem is with the Fed funds futures market saying they're going to cut rate 4 times this year. That's the problem. The markets, not necessarily the policymakers.
Steve, it's great to have you on when you're so level-headed in a time when it feels like markets are not. Thank you so much for joining this morning. Great to have you. Steve Ricchiuto of Mizuho Securities. Okay, coming up, China says it's open to talks with the U.S. If the U.S. starts showing more respect, we'll lay out those conditions that sources say China is starting to outline. That's coming up next on your brief.
Nvidia, it's one of the great companies of the world. Modern, super modern companies, controls segments that nobody, sort of controls the world in a sense.
How different the difference a couple days makes. President Trump talking about Nvidia just on this Monday, but on the same day, the administration told Nvidia that it's banning it from selling its H2O chip in China, down 5.5% in the pre-market, with the chip giant saying that it could take a hit of $5.5 billion from the restrictions. For more, let's bring in our Bloomberg senior editor for tech and strategic industries, Mike Shepard. I mean, Shep, wasn't this chip specifically developed to get around chip restrictions?
Well, that's right. They had designed this H20 chip to meet and satisfy previous curbs that have been imposed on sales of semiconductors, advanced semiconductors to China, really since 2022. And the U.S. has been concerned that these chips could be used to help give Beijing something of an edge in artificial intelligence, but also be used in military applications as well. So they invented this H20 chip with scaled down capabilities, yet it proved to be good in another area that's key to artificial intelligence, and that's something called inference. And it is something that is believed to be behind DeepSeek's success and that of other Chinese startups in making some inroads when it comes to artificial intelligence. So this was widely expected to be coming. Howard Lutnick, the Commerce Secretary under Donald Trump, within days of taking office, the administration had signaled something like this might be coming. And for all of Trump's praise of Nvidia and for Jensen Huang's meeting at the White House with Donald Trump, it really didn't seem to help. The U.S. sees this challenge from China in areas like tech and trade as something that they really have to take steps, including some extreme ones, as we see in the case of Nvidia, steps that they have to take, Danny.
It's a changing contour where it's not just overall trade level that's being targeted. It is individual companies from Nvidia to Boeing. But Shep, it does seem, at least according to Bloomberg reporting, that China seems willing to come to the table, but it's laying out conditions. What are those conditions?
Well, it sure is. And, Donald Trump yesterday, through his press secretary, Caroline Leavitt, kind of said literally, the ball is in your court, China. And now we're seeing Beijing volley back this morning. And our reporting signals that they are laying out a couple of conditions to be willing to engage in talks on trade now with Trump as this confrontation escalates. One, they would like to see a point person from the administration, somebody who has Trump's ear, but is not Donald Trump himself, to actually carry out these negotiations with the senior member of China's government. And Beijing just replaced their key trade minister in the last several hours, too, as perhaps a sign of their interest in advancing this. The second thing is they want key issues on the table. They would like to make sure that the tech curbs we were just talking about are included in the conversation. And they also want to make sure that the question of Taiwan, the self-governing island that has been this point of contention between Beijing and Washington for so long, is part of the discussions. And then three, they would like to see a more respectful tone from the U.S. Beijing has taken exception to some comments that it sees as disparaging from senior U.S. officials, including J.D. Vance, in recent weeks. And they want that kind of rhetoric to be dialed down for there to be any sort of conversation on trade, and including on taking steps that might see an easing of the U.S. tariffs that were imposed over the past several weeks, Danny.
Yeah, J.D. Vance using the phrase Chinese peasants, which received a lot of condemnation from the nation. Shep, just finally, there's some Wall Street Journal reporting that kind of echoes some of our own reporting, this idea that the U.S. is saying to its trading partners, it's either us or China. What does this fold represent in trade negotiations with the U.S. and other nations?
Well, you can sort of see this split emerging naturally. The European Commission trade chief was in Washington this week. It didn't yield a deal. The Trump administration likes to talk about, quick results, but trade negotiation usually takes years. They have a faster timeline now with the reciprocal tariffs that have been held in temporary abeyance. But that is one area where we are seeing what you could call progress. By contrast, there is not nearly that same level of engagement with Beijing. And likewise, with other key U.S. trading partners like Japan, like Korea, you're also seeing leaders and officials quickly stepping in to try to engage with the U.S. So it is almost like a bifurcation in terms of how the different capitals and different blocs are engaging quickly with Washington versus Beijing. It's something that's happening sort of naturally. And some of the groundwork have been laid early in the administration by those governments and by the EU in a way, in terms of reaching out to Washington and vice versa. Whereas with China, there really has not been that kind of high-level engagement or contact right away. And the differences are stark. And the Trump administration really would like to see this turned into much more of a you choose China or you choose us. And we are trying to make the terms as favorable for you as we can.
Shep, thank you so much for keeping us up to speed. A lot to get through. Bloomberg's Michael Shepard in Washington. Now let's turn to tech because ASML shares are sinking alongside Nvidia. But this is because of their earnings. The Dutch chip equipment maker reported first quarter orders that missed estimates. It cited weakness in the chip sector. The CEO also said that tariffs have increased uncertainty. Let's bring in Charlotte Hughes Morgan, who joins us now on this. Charlotte, what did we hear from ASML?
Thanks, Danny. Yeah, it's more gloomy signals, I'm afraid, from another key player in the AI supply chain. I mean, remember that ASML is the only company in the world that is capable of producing these advanced EUV machines that make the most sophisticated chips that are used by the likes of TSMC to basically power the AI boom that we've been seeing. And ASML, the key metric for them is bookings. So their first quarter bookings missed analyst estimates by about 1 billion euros. So we saw them come in at 3.9 billion euros for the quarter. Analysts had been looking at more like 4.8 billion. So that is obviously a disappointing result as far as bookings are concerned. Now, the company says, bookings are a lumpy figure. The lead times on some of the machines can be really long. But actually, that is the metric the market is looking at. And we see that reflected in the shares, right? We had ASML opening down 7% in Amsterdam today. Now, one thing that it is important to note is they kept their 2025 net sales guidance unchanged, 30 to 35 billion euros for the year. However, something that they did flag, essentially a tariff disclaimer. They said, subject to the uncertainties we're seeing in the macro environment. So investors are definitely kind of watching that closely and trying to kind of work out what will be coming next for the sector.
Charlotte, that's exactly where I wanted to go, because we are seeing a fascinating divergence between companies on how they handle their outlooks. ASML, as you mentioned, is keeping it. How is it interpreting tariffs? How is it going about communicating to the market just the type of impact that it might have down the road?
And it's a really interesting question. And I mean, ASML were quite upfront about the fact that they don't really know. I mean, the CEO in the release saying, we don't yet know how we're going to quantify the tariff implications, and flagging there's a huge amount of uncertainty, but they are obviously communicating with their customers and keeping an eye on the situation. And interestingly, the CFO in the video that is released alongside earnings basically laid out a number of different potential scenarios for these kind of sector-specific semiconductor tariffs that the US administration is planning to levy on these companies. And it, looked at everything from tariffs on the whole system, so the whole of the lithography machine, tariffs on certain parts, and they also considered the scenario where other countries actually levy tariffs on products coming out of the US. I mean, ASML actually has 20% of its headcount in the US. It has manufacturing capabilities there. So all kinds of scenarios could play out. But I mean, this unpredictability, this uncertainty is clearly weighing on the shares, and it's really weighing on the sector as a whole.
Yeah, it feels like this quarter is just a practice in scenario analysis. Charlotte, thank you so much. Bloomberg's Charlotte Hughes Morgan. Now, speaking of scenario analysis, United Airlines taking the unusual step of offering two potential earnings scenarios in its outlook. It said that its 2025 outlook does remain achievable, but it also warned that a recession could nearly have its profit forecast. Joining us now is Bloomberg senior aviation reporter Sid Phillip. Sid, just how unusual is this, the fact that we got two different forecasts coming from United?
It is very unusual. I mean, most airlines put out one scenario, and so this is actually very unusual for an airline to come out with two scenarios. But at the same time, it sort of shows the limited upside, the downside risk for United. I think United is trying to calm market fears, saying that, okay, there is a bottom in case there is a recession, then profit estimates will be halved. But at the same time, it's not as dire as anyone could predict it to be. So I think they're sort of trying to put a bottom on the sort of expectations that it wouldn't be below this. And that has sort of enthused the markets a little bit, because the shares were up in pre-market trading and the other airlines went up as well. Because remember, last week, Delta Airlines pulled their forecast for the year because of the uncertainty. So United's trying to come in and say, this is the floor for where earnings could be.
That is such an interesting idea, Sid. The fact that this was really a playbook for if you want to say things are uncertain, but you don't want to get crushed in terms of your share price, this is the kind of thing that you can offer. Can we talk about that downside scenario? Because as you say, it puts a floor on it, so our imaginations don't run wild. What exactly does that floor look like?
It does look like, I mean, the moment it's still, they're talking about how it could be halved from what their previous expectation was. And essentially, we still don't know for sure they are pulling out capacity. They're pulling out capacity in the third and fourth quarters. They're retiring planes earlier than they previously expected to, as well as sort of making sure there's not excess capacity in the market. At the same time, they are very dependent on international flying as well as on their premium traffic. And those are two sectors that could be hit in case the tariff war escalates further, as well as people sort of feel the pinch in their pockets and sort of downgrade to less lucrative economy travel.
Yeah, it will be interesting to see if those are affected. So far, it seems like only domestic travel has been impacted by some cuts to the government. Sid, thank you so much. Bloomberg's Sid Phillip there. And later today, a conversation you don't want to miss. United Airlines CEO Scott Kirkby joins Bloomberg Surveillance. That conversation at 8 a.m. New York and 1 p.m. UK time. Coming up, we get another read on the U.S. consumer and more Fed speak. We'll lay out your agenda for you next on your Bloomberg Brief. Let's get you set up for your trading day on this Wednesday. U.S. retail sales for March come out at 8:30 a.m. Plus, we'll get the Bank of Canada rate decision, 9:45 a.m. And Fed Chair Powell speaks at the Economic Club of Chicago at 1:30 p.m. New York time. A busy day started by a busy evening last night, bleeding into the future session. Nvidia, AMD, Intel all falling. Some of that has to do with ASML earnings that were very poor, but also Nvidia taking a beating this morning, down more than 5.5% after saying that they would take a $5.5 billion charge because the Trump administration is targeting their H20 chips and their ability to send them to China. Now, on this risk off, we're seeing a big move in gold. Recall that yesterday we learned gold was apparently the most crowded asset according to the Bank of America survey. That's not stopping more people from piling in. We're trading above 3,300 this morning, up 2.33% or thereabouts, easily at a new all-time record. All right, that is it for your Bloomberg Brief. Thanks for joining us this morning. Surveillance will take the reins from here. This is Bloomberg.